Hello students, welcome to the lecture on working capital management. And after this lecture, we will be able to learn the following objectives. Understand the meaning of working capital, explain the theories of working capital, describe the concepts of working capital, understand the planning of working capital investment, describe the working capital management under inflation. Let's start with the concept of working capital management. Working capital management is the device of finance. It is related to manage of current assets and current liabilities. After learning working capital management, commerce students can use this tool for fund flow analysis. Working capital is very significant for paying day-to-day expenses and long-term liabilities. Working capital is that part of company's capital which is used for purchasing raw material and involved in sundry debtors. We all know that current assets are very important for proper working of fixed assets. Suppose if anybody have invested his money to purchase machines of company, and if he has not any more money to buy raw materials, then the machinery will no use for any production without raw material. From this example, one can understand that working capital is very useful for operating any business organization. We can also take one more liquid item of current assets, that is cash.
Working capital management, or how companies can successfully leverage hidden liquidity reserves. Working capital management, which is closely correlated to financial supply chain management, concerns all companies, irrespective of their industry or current situation and performance. But what exactly is working capital? Companies buy goods and services from their suppliers, store the goods during and after the production process before selling them to their customers. This cycle takes up a high percentage of a company's available liquidity. Usually, the company only gets the liquidity back again when the manufactured goods have been paid for. This is exactly where working capital management can be applied. By optimizing various processes, the amount of tied-up capital can be reduced. The company can use the additional liquidity to make investments or fuel growth in new markets. How does it work? Let's take a look at two companies. Each take a completely opposite approach to financing its working capital. Classic Limited wants to highlight its creditworthiness and always pays its invoices as soon as it receives them. This means liquidity flows out of the company straight away. Modern Limited pays close attention to its working capital. Modern Limited agrees payment terms with its suppliers. Modern Limited is assisted by its principal bank, which purchases receivables from Modern Limited's suppliers. The suppliers in turn benefit from an attractive form of financing. To boost sales, Classic Limited has given its customers extended payment terms and consequently has to wait a long time for its money. If it is of strategic importance, i.e. in the interests of increasing sales or customer loyalty, Modern Limited grants its customers a payment term. By selling these receivables, Modern Limited benefits in three ways. It has an immediate inflow of liquidity. It has the chance to acquire new customers, and it benefits from a reduction of the risk of being left with the debts of its buyers. In order to avoid a supply shortage, Classic Limited maintains high inventories in its warehouses. The goods in storage were, of course, paid for a long time ago. Modern Limited has introduced efficient warehouse processes so that the right amount of stock is available at all times. Conclusion: unlike Modern Limited, Classic Limited needs a high level of financing for its working capital. Its comparatively high inventory and accounts receivable exposure weigh heavily on its balance sheet. As a result, Classic Limited can't afford to make new investments. The efficient management of its working capital strengthens Modern Limited's balance sheet. Also, it has sufficient funds available to finance its planned investments. Modern Limited does not need a bank loan right now, although it would have no problem getting one as its key financials are in great shape. What role do banks play in this? They finance clients' payables. They help their clients finance their production costs. And they purchase clients' receivables on their customers all over the world. So banks act as intermediaries. and support their clients' working capital management with a range of tailor-made solutions.
Working capital refers to the firm's investment in short-term assets, which is cash, short-term securities, accounts receivable, debtors, and inventories of raw materials, work in process and finished goods. It can also be regarded as that portion of the firm's total capital which is employed in short-term operations. It refers to all aspects of current assets and current liabilities. In simple words, we can say that working capital is the investment needed for carrying out day-to-day operations of the business smoothly. Let us now discuss the meaning of the working capital. A managerial accounting strategy focusing on maintaining efficient levels of both components of working capital, current assets and current liabilities in respect to each other. Working capital management ensures a company has sufficient cash flow in order to meet its short-term debt obligations and operating expenses. Ratio analysis will lead management to identify areas of focus such as inventory management, cash management, accounts receivable and payable management. Working capital is the amount of capital that a business has available to meet the day-to-day cash requirements of its operations. Working capital is the difference between resources and cash or readily convertible into cash, current assets and organizational commitments for which cash will soon be required, current liabilities.
Mike would like to know how long it takes his pizza company to purchase or produce inventory and then sell it and receive the cash. This is called the cash conversion cycle. There are 3 parts to the cycle. First, Mike must figure out his inventory conversion period. The formula is inventory over cost of goods sold per day. This will tell Mike the average time required to convert materials into finished goods and then to sell those goods. Next is the average collection period. The formula is receivables divided by daily sales. This ratio will tell Mike how long it takes him to collect cash after a sale has been made. Finally, Mike will need to calculate the payables deferral period, which will tell him how long his company takes between purchasing materials and labor to making payments for them. Now we will be able to figure out the cash conversion cycle. Mike will add the inventory conversion period to the average collection period and then subtract the payables deferral period from that sum. Now, Mike wants to look at his firm's working capital management. First, he learns that net working capital is just his current assets minus his current liabilities. Now he wants to know how many current assets to hold. The amount of operating current assets held will be a policy decision. There are 3 policies. The relaxed policy means that the firm will hold a lot of cash, marketable securities, receivables, and inventories relative to its sales. The restrictive policy minimizes its holdings of current assets, and the moderate policy lies somewhere between the 2 extremes. Now that Mike knows how many current assets to hold, he needs to figure out how to finance all of them. The 3 approaches are moderate, aggressive, and conservative. First, a moderate approach to short-term financing involves matching, to the extent possible, the maturities of assets and liabilities, so that temporary operating current assets are financed with short-term debt, and permanent operating current assets and fixed assets are financed with long-term debt or equity. Under an aggressive approach, some permanent operating current assets and perhaps even some fixed assets are financed with short-term debt. A conservative approach would be to use long-term sources to finance all permanent operating capital and some of the temporary operating current assets. Now, all that is left for Mike is to make the choices that will benefit his company the most.
Types of working capital. Ordinarily, working capital is classified into 2 categories: fixed working capital and fluctuating work capital. Fixed working capital. The need for current assets is associated with the operating cycle, which, as we know, is a continuous process. As such, the need for current assets is felt constantly. The magnitude of investment in current assets, however, may not always be the same. The need for investment in current assets may increase or decrease over a period of time according to the level of production. Nevertheless, there is always a certain minimum level of current assets which is essential for the firm to carry on its business irrespective of the level of operations. Fluctuating working capital. Depending upon the changes in production and sales, the need for working capital over and above the permanent working capital will fluctuate. The need for working capital may also vary on account of seasonal changes or abnormal or unanticipated conditions. For example, a rise in the price level may lead to an increase in the amount of funds invested in stock of raw materials as well as finished goods. Did you know that permanent working capital is that amount of capital which must be in cash or current assets for continuing the activities of business? Now we will study the theories of working capital. The theory of working capital management contends that if working capital is managed according to prescriptive theory, then it would be expected that businesses would invest in working capital, finance working capital, monitor factors that influence working capital, manage cash, accounts receivable, inventory, accounts payable, the cash conversion cycle, aggregative approach, and measure and analyze performance to ensure that the long-term or fixed assets are utilized effectively and efficiently. Working capital is said to be the lifeblood of a business, same way as agency management system. Working capital signifies funds required for day-to-day operations of the firm. Firm using CRM software and SFA software also required to work out working capital requirement. In financial literature, there exist two concepts of working capital, namely gross concept and net concept. Approaches to managing working capital. Approaches of estimating working capital are conventional method. The matching of cash inflows and outflows, this method ignores time value of money. Operating cycle method. This method takes into account length of time which is required to convert cash into resources, resources to final product to debtors, and debtors to cash again. Let's know the concept of working capital. There are two concepts of working capital, namely gross concept and net concept. Gross working capital. According to this concept, working capital refers to the firm's investments in current assets. The amount of current liabilities is not deducted from the total of current assets. This concept views working capital and aggregate of current assets as two interchangeable terms. This concept is also referred to as current capital or circulating capital. The proponents of the gross working capital concept advocate this for the following reasons. Profits are earned with the help of assets which are partly fixed and partly current. To a certain degree, similarity can be observed in fixed and current assets so far as both are partly financed by borrowed funds and are expected to yield earnings over and above the interest cost. Logic then demands that the aggregate of current assets should be taken to mean the working capital. Management is more concerned with the total current assets as they constitute the total funds available for operating purposes than with the sources from which the funds come. An increase in the overall investment in the enterprise also brings about an increase in the working capital. Net working capital. The net working capital refers to the difference between current assets and current liabilities. Current liabilities are those claims of outsiders which are expected to mature for payment within an accounting year and includes creditors, dues, bills payable, banks overdraft, and outstanding expenses. Net working capital can be positive or negative. A negative net working capital occurs when current liabilities are in excess of current assets. Whenever working capital is mentioned, it brings to mind current assets and current liabilities with a general understanding that working capital is the difference between the two. Net working capital is a qualitative concept which indicates the liquidity position of the firm and the extent to which working capital needs may be financed by permanent sources of funds. This needs some explanation. Current assets should be sufficiently in excess of current liabilities to constitute a margin of buffer for obligations maturing within the ordinary operating cycle of a business. A weak liquidity position poses a threat to the solvency of the company and makes it unsafe. Excessive liquidity is also bad. It may be due to mismanagement of current assets. Therefore, prompt and timely action should be taken by management to improve and correct the imbalance in the liquidity position of the firm. The net working capital concept also covers the questions of a judicious mix of long-term and short-term funds for financing current assets. Every firm has a minimum amount of net working capital which is permanent. Therefore, this portion of the working capital should be financed with permanent sources of funds such as owner's capital, debentures, long-term debt, preference capital, and retained earnings. Management must decide the extent to which current assets should be financed with equity capital and/or borrowed capital. Several economists uphold the net working capital concept. In support of their stand, they state that in the long run, what matters is a surplus of current assets over current liabilities. It is this concept which helps creditors and investors to judge the financial soundness of the enterprise. It is the excess of current assets over current liabilities which can be relied upon to meet contingencies, since this amount is not liable to be returned. It helps to ascertain the current comparative financial position of companies having the same amount of current assets. The importance of working capital management. Because of its close relationship with day-to-day operations of a business, a study of working capital and its management is of major importance to internal as well as external analysts. It is being increasingly realized that inadequacy or mismanagement of working capital is a leading cause of business failures. We must not lose sight of the fact that management of working capital is an integral part of the overall financial management and ultimately of the overall corporate management. Working capital management thus throws a challenge and should be a welcome opportunity for a financial manager who is ready to play a pivotal role in his organization. The planning of working capital investment. Working capital is the amount of liquid assets which an organization has in hand. Working capital investments are required to pay for unexpected and planned expenses, to build a business and meet the business's short-term duties and obligations. Working capital investment is the amount of money we require to expand our business, meet short-term business responsibilities, and cover business expenses. A startup capital, we can say, is the amount money we require to begin a business till it yields sufficient revenue so that it can pay for its own self. We can get working capital investments and startup capital from grants, loans, partners and investors, but a lot of business women put in to use their own personal resources of finance for funding their businesses. Working capital investment requirements. Net working capital investment requirements varies from one company to another. Within the same company, the requirement of net working capital investment could vary from 1 month to another. The requirement of net working capital investment is dependent upon two factors: what are the earnings of the organization and the frequency of getting these earnings, and the expenses of the organization and how often the payments needed to be conciliated. For knowing about calculating the working capital investment requirement needed for a new business investment, the managers need to create forecasts of earnings, which is inventory, and accounts receivable, and expenses, which is accounts payable. Post we have made the projections, we need to compare expenses with projections and the actual earning. Working capital investment management. Working capital investment management is crucial to make sure that the organization has sufficient funds for carrying out its everyday operations in a smooth manner. Any business should not have quite a long cycle for cash conversion. Cash conversion cycle assesses the period of time for which an organization would be divested of funds in the case it raises its investments as a procedure of its strategies for business growth. Working capital investment and overcapitalization. In case there are inordinate cash and stock debtors and few creditors, then there would be an excessive investment in current assets by the firm. Working capital investment would be inordinate and the firm would be in this respect to be overcapitalized. Return on investment (ROI) would be lesser than it actually should be, as well as long-term funds would unnecessarily be engaged when instead they can be invested somewhere else to gain profits. Determinants of working capital investment needs. There are no set rules or formulas to determine the working capital requirements of a firm. The corporate management has to consider a number of factors to determine the level of working capital. The amount of working capital that a firm would need is affected not only by the factors associated with the firm itself, but is also affected by economic, monetary and general business environment. Among the various factors, the following are important ones: nature and the size of the business. The working capital needs of a firm are basically influenced by the nature of its business. Trading and financial firms generally have a low investment in fixed assets but require a large investment in working capital. Business fluctuations. Seasonal and cyclical fluctuations in demand for a product affect the working capital requirement considerably, especially the temporary working capital requirements of the firm. An upward swing in the economy leads to increased sales, resulting in an increase in the firm's investment in inventory and receivables or book debts. On the other hand, a decline in the economy may register a fall in sales and, consequently, a fall in the level of stocks and book debts. Working capital management under inflation. It is desirable to check the increasing demand for capital for maintaining the existing level of activity. Such a control acquires even more significance in times of inflation. In order to control the working capital needs in periods of inflation, the following measures may be applied. Greater disciplines on all segments of the production front may be attempted as under. The possibility of using substitute raw materials without affecting the quality must be explored in all seriousness. Research activities in this regard may be undertaken with financial assistance provided by the government and the corporate sector, if any. Attempts must be made to increase the productivity of the workforce by proper motivational strategies. Before going in for any incentive scheme, the cost involved must be weighed against the benefit to be derived. Though wages in accounting are considered a variable cost, they have tended to become partly fixed in nature due to the influence of various legislative measures adopted by the central or the state governments in recent times. Computation of working. The number one reason most people look at a balance sheet is to find out a company's working capital or current position. It reveals more about the financial condition of a business than almost any other calculation. Calculating working capital. Begin by determining the current assets. Current assets are comprised of cash, marketable securities, accounts receivable, and current inventory. Sum the total value of each to arrive at the current assets. Now, in the end, let us summarize what we have learned in this lecture. Working capital is the amount of capital that a business has available to meet the day-to-day cash requirements of its operations. Working capital management thus throws a challenge and should be a welcome opportunity for a financial manager who is ready to play a pivotal role in his organization. Working capital investments are required to pay for unexpected and planned expenses to build a business and meet the business's short-term duties and obligations. Net working capital investment requirement varies from one company to another. Within the same company, the requirement of net working capital investment could vary from 1 month to another. Current assets are generally those assets which can be liquidated quickly whenever need them liquidated.